Okay. Well, my name is Ken Kopecky. I'm the editor of the Journal of Economics and Business, and several of the papers that will be presented over these 2 days will be published as a special issue on regulation. I'll have some more to say about that later on. But for now, I want to follow up on Bill's analysis of risk by saying that this is going to be a high return, low risk session. And to make sure of that, given the building that I'm in, I'm going to regulate it. And to regulate it to zero risk, I'm going to present to each presenter, 5 minutes to go, 1 minute to go, and the gong. And when they get the gong, I go out and I tackle them and we move on. So, each presenter will have about 17 minutes. I think Jalapa had promised them. And then the discussants, 8 minutes, is that right? Yeah. But I think for the most part, I'd like to shorten that as much as possible so that we can get discussion going on from the audience.
Go to session 2.
We had to move one paper from a session this afternoon, later on this afternoon to today. The paper that will move to the later on session is the first paper on the determinants of household bank switching. The paper that's going to move forward to right now is HELOC end of draw and payment shock as an emerging risk to banks. And the authors are Onesime, Epouhe, and Arden Hall, and Onesime will present the paper.
This is tomorrow.
It's in the second. Here it is. Oh, it's right there.
Yeah, it's here.
It didn't come up?
No.
The risk is rising.
Which one is? Yeah, it should be here. This one. Should go down. Go down. Go down. No. Go down. That's the last. Yes, last one. Let's go down. Go up. This one. Yeah, hey, look, you.
O or
yeah.
A? It'll be under O or A because it's first name.
Yeah, it's
There it is.
okay. Good. Finally.
At long last.
How do you open it?
Good.
This one.
Yeah, that should work.
Sorry about the delay. I was trying to handle some technical issues. And I know in the agenda you have a different presentation talking about bank switching. Now we are mostly experimenting about presenter switching. So we switch to presentation. I will talk with you in the next 20 minutes. I think I have 17. I will try to fit in 17 minutes about payment shock in HELOC. HELOCs at a home equity line of credit at the end of draw period. My name is Onesime Epouhe. My co-author is Arden Hall, who is in the room. Arden works from San Francisco on the West Coast. We were actually switching the time between the West Coast and the East Coast. That's how we had to switch the presentation. HELOCs are line of credit with a fixed draw period, which is usually 10 years draw period. During that time, the borrower can withdraw from the line of credit and only pay interest only. during the 10 years. But at the end of the 10 years draw period, the borrower has to start, for most HELOC, he has to start paying, amortizing the payment. And that can happen in two ways. One way is that the payment can come due at the end of the draw period. We call that balloon HELOC. Or the borrower can have to pay them through an amortizing period based on the contract that they have with the bank. That period can go from 40 years to 5 years. And the contractual interest rate at the end of draw also can change. Most likely it might increase, the interest might increase. Those two factors, the increase in the interest rate and the start of the amortization, are what will increase the required payment. The borrower who was only paying interest only on his loan will have now to start paying a loan that is amortizing or the entire balance. And that's what we call payment shock as we move forward. Historically, the issue of end of draw did not present itself. That's because, as Bill said, everybody was optimistic. The house price was always increasing. So the CLTV, if you have your loan, the CLTV was increasing. And if you take a HELOC, the end of draw here, we estimate is about 10 years. At the end of 10 years, you will have refinanced it, or if you just want to continue paying interest only, you can easily do that. So the issue was not there. Everybody was happy and things were going well. Then things changed with the financial crisis when house price start dropping. I will show a little bit more deeper what I'm talking about here. Just hang out with me a little bit. But today we have a large fraction of the bank, of HELOCs that banks are holding that are due to reach end of draw in the next 3 years, starting in 2015 to 2017. We estimate that that's about 59% of the outstanding HELOCs. We also estimate that about 23% of those loans are either underwater or will have difficulties refinancing when they reach end of draw. And there has been concern that you probably have seen in the press that when that happens, there will be another housing crisis or something like that, depending on who's writing. Some people think that it will be a big issue. So we have data here today that we have been collecting for the Dodd-Frank stress test, Y14M, and we have used that data to try to analyze that issue. And the work that we are presenting today is based on that analysis. In this slide, we show to you, when we talk about payment shock, how big can it be? Literally, it can be, the payment can double at the end of draw. The magnitude of the change of payment will depend on how many years you have to pay down your loan and by how much your interest rate increase. We have in the yellow in the yellow quadrant here in the middle what we think is the likely case, which is most of the loan that we have, the bank are holding today, have between 15 years and 20 years of amortization. And the interest rate on the portfolio that we have looked is around 4%. And we estimate that, or we just make the assumption for interest rate, we don't know what will happen with the interest rate, that the interest rate could increase between 4 and 5%. And if that happens, most of the HELOCs, when they reach end of draw, the payment will double for those who are required to pay. Those who are balloon loan will have to pay them. Then the question is, what happened after that? And how did we get there? That's where this slide shows us basically historically trend in origination of HELOC over the past decade. We can see here that most HELOC actually were originated at the peak of the housing bubble when the price was high. And those are the loans that are still in the bank book. But when they were originated at that time, the price was high. Then the price collapsed. Literally, the red line over there is the price, the house price index. It fell. It fell down in 2008, just after the majority of HELOC in the book today were originated. So, and the consequence of that is that the CLTV, which is the combined loan to value ratio for those loans, went up, and they could no longer refinance their loan. So they stay there and waiting for end of draw to happen. The next graph is a consequence of the first one that we presented. Here we show to you the survival rate of loan by vintage. And we can see that at the bottom of the graph, the curve at the bottom are loans that were originated in 2002, before the housing bubble. For those loans, only maybe less than 10% survive. At 10, in the horizontal, we have the end of year. 10 years is basically what we estimate is the end of draw. By year 10, less than 10% of loans that were originated in 2002 stay in the book. But you look at the line on top, those are loans originated in 2008, 2007. Those tend to survive, they stick around. They have not been able to prepay. And that is the main concern that we have, and that we try to analyze. And the consequence is, here we have the distribution by the year of end of draw of loan that we have today in Y14M. Let me take a step back to talk a little bit. Maybe some of you might ask a question about the Y14M. Y14M data is the data that we collect and that's managed here in Philadelphia. It has loan level data for all the big banks with any substantial HELOC portfolio in it. So what we present here is from that data, we estimate that it covers about 60% of the HELOC market. So you have a representation of 60% of the HELOC market here, and you can see that the majority of those loans will reach end of draw between 2015 and 2017. And the majority of them have the number of years of amortization between 20 years and 15 years, which correspond to what we showed to you before in the yellow quadrant. And our research objective is formulated around those observations, which our goal is to measure the impact of the increase in payment imposed at the end of draw on the probability that the HELOC borrower will default. To achieve that objective, we use a sample of accounts that have either reached end of draw or are approaching it to estimate a competing hazard model of default and prepayment. We relate the default and prepayment to the timing and the size of payment. We are able to do that because we have detailed information in Y14M about when those loans will reach end of draw and what payment, we can calculate what payment will be required at that time. Now, there's a concern that when HELOCs reach end of draw, there will be increase in default. And that concern comes from previous research that has been done mostly on first mortgage. There has been a lot of research on first mortgage indicating that when first mortgage with the payment that change at some point, when that payment change, there is, if the change is an increase in the payment, there will be an increase in default. And those are the studies that we have here. It's only recently that people started looking at the HELOC. And one of the study, or the only study that have done that so far is the study by Johnson and Serama, which will be presented to you here, I think today, again, that has looked at the same question we are looking at. They use a different data set that has a longer time period. We focus mostly on Y14M data set, where we have a shorter coverage in terms of time, but contains detailed account level information in terms of the characterization of end of draw. I have to move a little bit faster, and the next 3 slides we show to you the risk characteristic of the loan that we use to estimate our model. This basically prepare you to see the result that we will show to you and the conclusion that we reach. In summary, those loans have very good risk characteristics. Only 20% of them have are underwater. That means they have CLTV above 100%. When we look at the FICO, we see that 76% of those loans have prime level FICO. So very few of them have bad FICO. Then we look at the third risk characteristics, which is the utilization, which is the balance divided by the credit limit. And we see there also that about a third of them, of the loan reaching end of the next few years, are utilizing less than 50%. of the balance, which is still a very good loan by all measure. Now, to estimate the model, we analyze default in standard competing risk framework, where the default and the prepayment are at the terminal stage. We use Y14M data as we initially said, and we use a 5% sample of account to estimate a model with data from the period starting 48 months before end of draw to 24 months after end of draw. Our data, as we said initially, cover a short time period between June 2012 and September 2014. June 2012 is the concern. That's when we started collecting Y14M, so we cannot have more than that. The result that are presented in this table, let me just take a few seconds to explain the independent variable. We estimate the default and the prepayment model. The first half of the table to your right, if you can see it, those are variables that are used in most models, so I'm not going to spend time. But the bottom of the table, that's where we have the variable to measure our payment shock. We measure the payment shock here by interacting the size of the shock with the number of months to end of draw. And we also look at balloon loan, which are loans that are required to pay the whole balance. And we look at IO at the bottom variable, IO variable. We expected those IO loan after end of draw. That's loan that after the reach end of draw, they are not required to start amortizing. They could continue paying interest only. Our expectation was that those loans, there would be no impact on end of draw. But as you can see, unfortunately, we do see an impact, and we're still trying to understand what's going on there. But for the standard variable, our results are what we will see much paper. For the payment increase, we see that the payment increase actually do raise the default and the prepayment. It raised the prepayment more than the default, which let's keep that in mind, because when we move in the simulation, you will see how that play out. So on this slide, we did some simulation to try to see for a loan with this characteristic, how will the cumulative probability of default and prepayment move from the end of draw to 24 months after end of draw. And what we can see here on the first two graphs, we have a loan with 70 CLTV. The main difference is the CLTV, which moved from 70 to 130. We can see clearly how the default, cumulative default rate increase and the cumulative prepayment rate decreases. But it's more interesting if we look at the last two graphs. In the last two graphs, we have balloon loan. There have been a lot of concern that balloon loan, when they reach end of draw, will default massively. But you can see in either you look at loan that have very, very high CLTV, which is the last one, or the third graph where the CLTV is 70. But the FICO we are talking about here is 600, which is still a subprime loan. We can still see that the default rate, even for those loans, is not high. It's not high because what's dominating everything that's happening in those two graphs is the prepayment. A loan will only default if it has not prepaid. And what happened for those balloon loans is that when they reach end of draw, they prepay, so they are no longer candidate to default. Although if you emphasize only at looking at the model, which you presented in the previous slide, you will see that the coefficient is high for the default for those loans. But they will not default because they will have to pay for. So in conclusion, I have 1 minute. Our results support the hypothesis that the payment increase raises the probability of default. As expected, we found an impact of end of draw to be highest for balloon HELOCs. However, the result of our model and current HELOC portfolio risk characteristics indicate that relatively very small proportion of HELOCs only are at high risk of default when they reach end of draw. for the most of the loan in the portfolio today, that risk is not as high as you might read in the papers today. The analysis that we have presented here is based on about 2 years observation. And we have more data today. We continue to collect data on Y14M, and we will update this model as we get more data. But we don't necessarily expect to see the other result. However, we expect to look more closely as a result that we have seen on the IO that are still posing to us. Thank you.
Thank you very much, Onesime. Our discussant is Akhtarur Siddique from the OCC.
Yes. And you are actually running into the issue that my preparation of the discussion was actually JIT, just in time. So it is not actually on the, so I have to actually get that open, yes. That's, yeah, exactly, yeah. Okay, thank you. So actually, first of all, I thought it was a very interesting paper, and it was obviously very, very current data, and as they have also summarized the paper well, it is on the impact of payment shock at end of draw, and they find that higher default is associated with higher payment shock, and they define actually the payment shock as the percentage change in payment as well as the dollar change in payment. And actually what I found most interesting in the paper is the analysis of what drives this higher PD and higher prepayment. They found higher PD associated with higher CLTV, which obviously with higher CLTV, it means that there is less of an opportunity for exit via actually refinancing by the actual borrowers, as well as lower FICO, which again is actually consistent with the same story. And they found anomalies in actually current spread and low utilization as explanatory variables. Now, I saw there's, and I should say that I don't have a paper in this area, so I cannot actually talk about what I have done. So I have to actually see what others have done. So there is actually a TransUnion study from August 2014, which was actually quite interesting. They talked about $438 billion, which has not yet reached end of draw as of 2013, and 26% of the balances are in subprime. So that would be one suggestion I would have for the authors is to basically look at instead of equally weighted, do it as balanced weighting, because that is probably more useful economically and more intuitive. And they used a metric called aggregate excess payment, which was basically total payments minus total minimum payments due, which is again a very, very intuitive metric, which is essentially a measure of the capacity to absorb a payment shock. But it does require data on other obligations of the borrower. It's much easier for a credit bureau to have that data as opposed to us as regulators via Y14, unless you ask your vendors to collect to actually somehow match the Y14 M data to the credit bureau data. But it is possible that the Y14M would contain things from which you could have estimated income, which would again be a measure of the capacity to pay. And other sort of important concern, if you read about this end of draw actually payment, it is actually quite large because by any measure, 438 billion is very, very large. The other fear is really contagion. That is, HELOC actually payments would cause defaults in other loans by the same borrower. And there is actually a paper it is from the New York Fed. It came out within the past 2-3 months, which is based on their consumer finance survey, which actually finds some evidence that borrowers borrowers are basically substituting out of unsecured borrowings such as credit cards into HELOCs. Obviously, it's lower cost, but then it puts your house at risk. So obviously, that is the actual trade-off which actually many borrowers took. But without having other data, it is actually hard to measure that. So it is easier for one to suggest, which is to add other credit bureau data. But the other alternative is to basically aggregate by, say, zip codes or metro codes, and actually look at your performance at that level. You would probably still have enough observations and enough cross-sectional variation, given that you're actually basically using HPI as the driver, where again your data is likely at the metro or zip code level. So you do have loss of granularity, but you might be able to explore other explanatory variables. Suggestion, and other suggestion I would have was that estimates of the aggregate payment, aggregate impact would be important. Now, other work I have done is that there is substantial cross-sectional variation across banks. When a borrower defaults, it is not just the risk of the borrower, but also risk management by the institution that matters. And therefore, two borrowers who are otherwise identical may default at one institution, but may not at the other because of risk management. So that is an important consideration. And since you do have information on the banks, you should try to exploit that. You should try to exploit and try to understand, for actually one thing, repayment rules appear to vary across banks. So you would likely see your PDs also vary across banks, and they would likely be correlated across the repayment rules, and more importantly, how they're enforced, because that is basically risk management, and again, that actually varies across institutions. So you should try to exploit that. Other suggestions is that the macroeconomic variable you're using is state unemployment. Also, perhaps examine local macro variables, like the one you see at least industry folks try is non-farm payroll, initial unemployment insurance claims, and unemployment rates, where again you would get variation across zip codes, across counties, and it should increase the statistical power of your results. And the last one is you may have possible econometric issues. That is actually something you may get from your referees, that you do have an endogeneity identification issue, given that HPI and default are correlated. It's not a big deal to me, but it can bias some of the estimates upwards, and it would be useful for you to at least have some diagnostics to check. Okay.
Thank you, Akhtarur. Before I let you respond, I'd like to see if there are some questions from the audience, because I thought most of the comments were very constructive and very positive. So does anyone have any questions in the back?
The interest only at end of draw, so isn't that kind of sort of an unexpected phenomenon that going in you thought that end of draw and interest only were kind of the same thing, and would at end of draw you also end the interest only? So what's going on with something that hits end of draw and is still interest only? Is that an endogenous outcome, as Bill might refer to it, or kicking the can down the road, or was that in the original contract?
Can I respond to that? Or?
Yeah, you can
I
proceed.
think that was actually a direct question. I think that that's not the result we expected, as we said it, maybe not very clearly. We expected those loan who are interest only after end of loan to have no impact.
Would you come up here? I don't think your microphone is working.
Yes, it's not an expected result. We expected it to come the other way around. It didn't come the way we expected it. And we're still analyzing. We suspect that there might be a data issue with that variable. And also the time, the length of time we're analyzing is not long enough. That might also be the other issue. And the third issue might be that the number of loans that are in that category is just so small that it's not big enough to analyze it. It can also be an indigeneity issue or a selection issue, actually. So we still have some work to do on that.
Okay.
I'm wondering if you considered the role of the adjustable rate during the drawdown period in borrower behavior. If rates had fallen as they did, people might have taken advantage of that, borrowed to the limit even though they didn't really need the credit in the sense that they were liquidity constrained. And now they've maxed it out, but they still have the capacity to repay once they have to. And you've got this control for payment capacity, which is how much they pay over the min due. But if they had been borrowing just to take advantage of low rates, that wouldn't really demonstrate a lack of capacity either. And so I guess, yeah, those were my comments. Thank you.
Well, so I guess I'm the other author, I'll reply. It certainly could be true that there are people who have drawn this money out and they're liquid and they could pay it off. And I guess we would expect that that's why we don't see, 100% default. I mean, there are variations, right? Not everybody defaults if they have a large payment increase. But presumably, if you could identify people like that, you'd be able to differentiate more. But that's pretty difficult for us to do. We don't know what the purpose or the timing of the draw was.
Well, you might consider looking at the interest rates. I mean, one thing to explore is if, say they've got a payment shock. I don't think you differentiated between sources of payment shock. One could be they have a high payment shock because the interest rate goes up. In that case, I would think that you'd have a lot of prepay. If it went up because, there's amortization, then those people who just borrowed to take advantage of the low interest rate might, not prepay very quickly. So
We'll look into that. I think it's a good suggestion.
Yeah, I just have a couple of quick questions. So when you're talking about the balloon payments, right? Obviously, we don't have a lot of data for HELOCs going through this sort of payment shock, because as you say, it's mostly ahead of us. Do we have data on what happened to first lien balloons? Because they would have had big payment shocks too. In fact, of course, in dollar terms, it's probably even bigger, you'd imagine. And do we have any data there? How does that compare? How do default rates of balloons hitting, the payment rate, payment date? How does that compare? And I was just struck by your chart, the final one on the right, where you talked about the CLTV. If I understood it right, you're saying if you're in a CLTV of 130 at the date of the EOD, right, the end of draw date, then you go 2 years out, it looks like you have like a 50% cumulative prepayment rate or payoff rate. It seems a little high to me because, these guys with the CLTV of 130, they have nowhere to go. If they can't refi. They can't get another second lien to replace this, right? So, do you think that that's a reasonable outcome? I mean, you think that 50% of the people would actually, subprime borrowers, 600 FICO would be actually able to pay? Is this what sort of a scenario is this? Is this a stress scenario? If you're, is it like a CCAR severely adverse type scenario, or are you assuming some sort of a baseline scenario.
Just a quick request from the audience, please speak your name and affiliation before you start your question.
Yeah, so sorry. My name is Rajesh Govindan, and I'm from JP Morgan Chase.
What we present there is just a simulation of a typical loan with the characteristics that we have. I wish I can quickly go back to that. And those loans have, I think, a FICO of 600. They are subprime, as you said. But what you can see from our estimates is that the probability of prepayment is actually very high. And because we are using the competitive risk aspect of things, they are more likely to prepay than default, although they still have a high probability of default, but most of them prepay. And the other aspect of it is when you look at the balloon loans, the balloon loans actually probably have been in the book for a long time. So the balance might not be the same and all that. We can look at the balance and explain it. There's a difference also coming from somewhere else on the balance and the fact that maybe that loan was originated maybe 20 years ago and things like that.
Well, and if I can add, these are balloon loans, and so the payment is due at that point. And so I think, you know, to James's point, we kind of interpret that result as being people understood that they had a balloon loan and that the balance was going to be due to a greater extent perhaps than someone who had an amortizing loan. And therefore we see, if you look at the graphs, you see the gigantic drop or a gigantic increase in prepayment almost immediately. So that's really maybe contractual repayment.
Okay, well, thank you. We're under a time constraint here. We need to move on. Our next paper is Unexpected Housing Price Changes, Identifying the Drivers of Small Business Finance. The authors are Pablo Cabanos, Tammy Gurley Calvez, and Candice Cabanos, and the presenter will be Pavel. We can find it.
Yes. Where
If
do
we
I
can
look?
find it.
Here.
It's under your first name is Pavel. It should be under P. Yeah.
Thanks. Good afternoon, all. I'm Pavel Kapnos from the FDIC. I'd like to thank the organizers for the opportunity to present this paper and get feedback at such a great forum. This is a joint work with co-authors from Kansas University and Rand, and the standard disclaimer applies. None of the views expressed herein reflect the position of the FDIC. So the reason why we're interested in taking a look at how housing price changes have affected small business finance is twofold. One, we know that the most recent recession was caused by a housing crisis, and that was unusually painful by historical standards. Housing prices dropped by about 30% nationally and more than 40% in some of the hardest hit locations. And later in this presentation, I'm going to show you some coefficient estimates, all of which describe changes in dollar values due to a basis point shock to housing prices. And so it's important to keep in mind that with housing prices declines like that, and whatever coefficient estimates you will see, you'll need to multiply by about a factor of 3,000 to 4,000 to get the cumulative effect during the recession. Along with disruptions in other sectors of credit markets, the plummeting housing equity may have adversely affected small business finance. Small business finance is particularly important because small businesses comprise a large share of the U.S. economy and are sort of at the front lines of dealing with consumers. So the main contribution of our paper relative to some other studies that have looked at the effect of housing prices on small business financing decisions is an attempt coming from the macro side, which is where my background is, to disentangle the effects of anticipated and unanticipated housing price changes. Again, this is a particularly fortuitous, I guess, in a way, case study, in that the collection of the data for the Kaufman Foundation survey completely unintentionally, but almost precisely coincided with the timing of the most recent housing crisis. And so it would be a shame not to spend more time analyzing the interplay of those variables. The way that housing prices are treated in a large segment of small business literature is studies their effect on employment outcomes, and I think that field has been studied very extensively. However, the way that housing price changes are typically introduced in the empirical frameworks go along two lines. One, people use historical housing price changes as a right-hand side variable, essentially some lags of housing price changes, which going into the crisis may not be accurately capturing people's expectations going forward that are important for informing, say, financing decisions for small business owners. Another approach is to use residuals either from cross-sectional or panel regressions. And again, this is going to accurately describe some local departures from some sort of a national standard, but they're not going to, or are unlikely to capture the turning points in the business and related housing cycles very well on the basis of information that's available to economic agents or small business owners in real time. And so what we do is try to move beyond this use of housing price measures that have been done before and move in the direction of a very standard macroeconometric approach, namely forecasting, and essentially decompose housing price changes into forecasts. Or the anticipated component of the housing price changes, and forecast errors, which capture the unanticipated component. And we use a fairly large number of variables to sort of capture different levels of granularity and different types of information that may be available to people who perform these forecasts and base their decisions on them. So our main result is that we find that the unanticipated housing price changes matter more. They matter more than the actual housing price changes. They matter more than forecasts. And they tend to have stronger and longer lasting effects on small business financing variables. For a wide selection of those variables. So let me begin describing the substantive part of our work by taking a look at the data. We essentially have two distinct parts to this paper. One is very macro, the other is very micro. On the macro side of things, we have state-level housing prices that we're going to use for the second stage. And we form different models, different forecasting models to obtain housing price forecasts and forecast errors using different macroeconomic drivers. And those can be loosely categorized as no laser, national and state level macro variables, and one, I think, novelty in our forecasting exercises that we also try to capture some forward-looking information that folks may have had in real time. And the Philadelphia Fed runs a very great resource, namely the real-time data center, and we use the data from the survey of professional forecasters, not because we believe that small business owners, check in with the data set on a regular basis as they may plan their decisions, but because those variables tend to reflect changes in the consensus about the future direction of the macroeconomy. So we form different forecasting models on the basis of the data from 76 to 98. We evaluate those models on the basis of the macroeconomic data from 1999 to 2011. The forecasting models are updated on a rolling basis. And the micro data that I'll describe shortly is from the Kaufman Firm survey, covers it's annual and covers years 2004 through 2011. Okay.
Goes fast, it does, I know. Academics are like that.
So we have a suite of fairly standard forecasting models at the state level. I'll skip the details, but basically these forecasting models for the housing prices allow us to obtain the out-of-sample forecasts and forecast errors as measures of the anticipated and unanticipated components. So the bottom line from the forecasting part of the exercise is that particularly national variables and real-time forecasts do improve the forecasting performance quite a bit relative to other benchmarks, and we incorporate that data into the forecast that we use in the micro portion of the paper. So the dependent variables that we take a look at from the KFS can be subdivided into cash flow, credit card balances and maximums, and loans that have described these different facets of small business financing decisions and behavior. And in our microeconometric model, we have a standard set of controls for firm or owner characteristics. And so this is important for the microeconometric model. We run these regressions where we first regress financing variables on actual housing prices, where R captures the lag of a year and varies from 0 to 4, which allows us to trace out the dynamic responses of small business financing variables to housing price changes. And in another specification, we essentially decompose these actual housing price changes into their forecasted component and the forecast error to see which of those two components is driving that cumulative effect. And so, it's big, fortunately it's bigger on this screen. Our results suggest that a lot of these small business financing variables respond very strongly to housing price changes, especially to start with accounts payable. A 1 basis point housing price decrease leads to small businesses showing difficulty in making their payments, about $100 increase in those balances. That happens on impact, and importantly, it persists for a number of years, and as time goes by, the effect of the surprise component starts to dominate the effect of the anticipated component quite strongly. Eventually, the anticipated component becomes statistically insignificant, whereas the unanticipated component remains large and statistically significant. For credit cards, we find very weak responses on the personal credit cards. There is some evidence that small businesses start racking up their maximum limits and immediately in response to housing price shocks, but they don't really increase their balances, or that effect is not very long lasting. However, on the business side of things, those effects are quite large and persistent. So with respect to business credit cards, small business owners seem to ramp up the credit card limits very strongly. But it also turns out that they do not use all of those facilities, so there seems to be some of the precautionary behavior at play here. That is, they want to have the extra cushion, but do not necessarily use it. And again, the effects from the unanticipated components seem to last much longer than the effects of actual housing price changes or the anticipated component. So for loans on the personal side of things, again, the results seem to be pretty concentrated toward on impact of housing price changes. The positive coefficients here seem to signal that people, small business owners, obtain personal, family, and personal bank loans during the good times, but the negative coefficients on the amounts owed suggest that they start to slow down on their repayment when the bad times hit. And again, the effects seem to be longer lasting for the unanticipated component. And similar results apply to business line of credit balances that have the same flavor to it. And one result that is economically and statistically so insignificant as to become very interesting, the effects of housing price changes are essentially zero from any perspective that you look. It happens with respect to business bank loans. Nothing happens essentially there in response to housing price changes. And given that banks may be better equipped to essentially discriminate between better and worse performing small businesses in a crisis, that may be something that could be changed going forward. So in this paper that's okay. We've decomposed housing price growth into expected and unexpected components. We have shown that it is the unexpected housing price changes that appear to have the strongest effect on small business financing decisions. And going forward, given the importance of the sector to the U.S. economy, it may be advisable to expand the role of the formal lending channels to small businesses to prevent the spread and the depth of the future crisis. Thank you.
Thank you, Pavel. Discussant for this paper is Nada Mora from the Federal Reserve Bank of Richmond.
Thanks, Jalapa, for inviting me to discuss this paper and to attend the conference in general. And the usual disclaimer applies, of course. So what's the research question in this paper? So they start with what's the effect of house price changes expected and unexpected on small business finance? And the advantages, as Pavel was saying, is there's this Kaufman firm survey that coincided with the house price increases and decreases. So this, and it's explicitly on these startups that were born in 2004 and tracks them annually. And these small new firms we expect them to be most likely to be credit constrained. So again, many of them are very small firms, 98% fewer than 25 employees. And in earlier research descriptive on the Kaufman results, they find that they've rely heavily on external debt. So a lot of, surprisingly so, a lot of, I think like 44% of their financing comes from debt sources versus, for example, like 10% only from personal credit cards and family and friends. So, so it's zooming in on this Kaufman firm survey, and then the other advantages joins up with this literature on the methods to forecasting, macro methods to get the house price shocks. So what does the paper find? So they start by decomposing the house price changes at the state level into the expected component and the unexpected component from this autoregressive distributed lag model. So these are essentially augmented with these national, state level, and also the survey of professional forecasters as exogenous drivers in those models. And what they find is a significant effect of house price changes on various forms of debt finance. So, for example, higher house prices decrease the use of costlier sources of credit. So these would be like credit cards, accounts payable, form of short-term credit. Higher house prices also are found to increase personal bank loans and family loans newly obtained. So this wasn't emphasized too much in the talk, but in the paper you go into this a lot. But it's associated with lower amounts owed overall, and the reasoning in the paper is that businesses reduce payments on loans when house prices fall, and but the effect is found more strongly on the personal bank loans than the family loans, and the reasoning in the paper is that borrowers or businesses are more interested in meeting their obligations to their family. It could just be also that families more willing to forgive your debt, right? So that's another alternative. And as Pavel was saying, there's no significant association between house prices and business bank loans. That's interesting to explore more. But they do find, I didn't add it there, on the lines of credit from business lines, there you have that precautionary effect where when house prices fall, they are found to draw more and increase the balances. And that, particularly on that lines of credit, that unexpected component has a long-lasting effect. So that's the main summary. So my comments, my first comment is the motivation seems a bit limited to small business studies. So I would widen the motivation to a bit more theoretical underpinning of credit market friction. So, just general pledgeability of collateral enhancing a firm's debt capacity. And so, asset price shocks, positive asset price shocks increase the collateral value, and that amplifies the cycle. So there's various papers there, and I'd also widen it to other empirical studies on some of the larger firms. So for example, from CompuStat, there's been some papers looking at, again, this collateral channel and how real estate shocks affect investment and other outcomes. My second comment, this is a few slides on this one. So the identification of exogenous house price shocks. So the identifying assumption is that house price shocks are exogenous, and all other factors determining credit needs and supply for a firm in a particular state year are controlled for. And so this would relate to the first part of, so in this paper they focus on, one of the reasons cited by Bernanke for, why small businesses were hit more in the crisis. So this is a worsening financial condition, say due to lower house prices. But there's also other factors, weaker demand potentially for their credit by these small businesses, let's say due to lower sales, and also less credit availability directed more so at the small firms. So it's true that housing is the main collateral for small businesses. So there's various proxies for small businesses in different studies. So for example, the Federal Reserve summary, they look at from the flow of funds, proxied by proprietorships and so on. So around, close to 80% of the debt there is mortgage debt. Looking at an alternative survey of consumer finance, they focus on self-employed as proxies there. And again, you see that the median value of home equity debt shot up more for those type of self-employed than working for someone else. So, again, it makes sense that house price shocks would affect these small when there's a negative after 2007. But, again, there's these other stories, alternative channels working there, and, the weaker demand. So, various studies, for example, Sahan et al., greater decline in sales. Just 1 minute, okay. So I need to speed up here. And less credit availability as well, so I'm not gonna go into all that, but, the US literature has finally discovered the effect of bank loan supply on asset prices. Okay, so how would I suggest to address this? Well, I'd like to see more controls. I think you only have like unemployment. You partial out somewhat in the house price, but it'd be good to control more than just the unemployment rate. So, control for local credit conditions, control for local demand conditions affecting these small firms. So I think the KFS collects, based on the other studies, information on their revenue, profits, so on. Their sector, that's important. Drill down from the state, maybe to the MSA county, and also interaction terms would be very helpful here. So borrowers expected to be more credit constrained should be the ones. And so in that Robinson paper, they find that firms with more physical assets, higher credit scores, so proxies for lower asymmetric information, are more likely to obtain external debt. So try to work more with those type of measures that you have. My third comment, in less than a minute, on the house price model, so that, again here, what was I gonna say? So the basic model seems to make sense, but it's odd that the biggest forecasting improvement comes from augmenting with national factors, not state level. So you provide that evidence, and that's a bit surprising, and you don't go into that in the paper. So especially since we see that quite heterogeneity across. And I'm going to skip the first one. And is it possible to also get directly at measures of expectations of house price movements rather than rely on a forecasting model, right? Maybe from another survey as well. Final comment, other empirical implementation. Maybe I'll also skip some of these about how do you measure the dependent variable. Be good to measure it maybe as a share of a firm's capital expenditures to get a sense. Can we get directly at whether that's secured by real estate or not? Okay. Again, the models seem to be estimated for each lag separately. I know you want to trace out the dynamics, but you can combine them into one specification. Again, the sample is nice, 2004, 2011. Look at differences between the positive and negative shocks, right? And then also cross-sectional, Arizona versus Pennsylvania, where prices didn't move much. Okay, other comments I'll skip. So it's a nice direction to tie this KFS survey to local house price movements. The literature so far using that KFS has been more descriptive on the capital structure of these small businesses, and be worth looking at other firm outcomes as well. And again, you're back to that same problem. Like there's this nice Wall Street Journal article describing this small business owner. He's a restaurant owner. He had this secured debt with his home and his parents' home. And then his bank failed, and then he's a restaurant owner, which is cyclical. So how do you, disentangle all these things, right? So, interesting. Thanks.
Thank you, Nada. A lot of questions. Any other questions from the audience? At the back.
Simon Firestone from the Federal Reserve Board. Just to echo some of Nada's concerns about identification, and I think if you can't come up with a clever instrument of some kind, you're probably best off, doing a VAR, or something like that, just because, there's no real good way to pin down the directionality of causality, I think, and that's what you're going to get pounded on, I think.
In terms of the effect of changes in the small business financing variables on housing price changes?
Yeah, I mean, just like Nada said, I think it could go either way, and so.
But the bar wouldn't do it, the micro aspects, I don't think.
It would have to be a mixed
Very
time series.
complicated. In the back?
Yeah, on this point about identifying that difference between credit demand and credit supply.
John, can you speak on the microphone? Use the microphone.
Yeah, on this identification question. So you have these credit limits in the credit card data. So do you see any evidence of lenders who are actually pulling credit lines on these borrowers? That might be a way of seeing whether whether this the credit supply curve shifted, and maybe your elasticities are even bigger than what you're measuring, because these borrowers are sort of running into a constraint.
It is possible. Being a macro person, I'm not a KFS expert, and my sense is that the data credit being pulled is not available. But the demand versus supply effects would be very interesting to look at, and we'll spend some more time thinking about those things.
Anybody else? Do you want to respond to some of the comments that Nada made?
Well, so first of all, thanks a lot for such a thorough discussion job. I think Nada has made a lot of very relevant and interesting points. Some of the fixes are going to be easier than others in terms of controls. I think we can expand that quite easily. In terms of some model specifications like interaction effects or asymmetries, that's actually something that we spent a lot of time discussing and thinking of bringing it in. So we'll try to estimate those specifications as well. Going towards more granularity may be a little bit more challenging. Again, not being a KFS person, I don't have a great sense of how doable that is.
Thank you, Pavel. So we'll move on to the next paper, checking account fees, involuntary account closure, and neighborhood demographics. The authors are Tim Richfield and Catherine Samolik, and I think Catherine is going to give.
Can I sit up here?
You sure can.
Is there any way I can just sit and then click the thing?
That I don't know. I bet you can. Here's the IT
I can
guy.
stand though too. It's
Here's
okay.
the IT guy. He'll figure it out for you. Here.
So,
No, I just, this thing.
Yes, for it.
Thanks.
Right.
Good afternoon. I'm Catherine Smolik, and I'm happy to be able to present this research. This is self-directed, independent research, and I'm no longer at the CFPB, but my co-authors and I were all there when we wrote this paper, so I do have to say it doesn't reflect any views of the CFPB. It doesn't reflect views of anywhere else I ever used to work. So we presented a first version of this paper, and this version builds on that at the FDIC Consumer Finance Research Conference in 2013. And so Karen gave us comments there, and now my other former colleague, Ryan, is going to give me comments here, and I look forward to them. So basically, this paper uses amazing account level and transaction level data that the CFPB collected in the context of its research and policy efforts looking into bank account fees and overdraft fees more specifically. And so we basically have a random sample, very large random sample of consumer checking accounts at a small number of large institutions. So the institutions we're using, the accounts we're using in this paper, all of the banks had standard overdraft type programs where they allowed people to opt in to the coverage of their debit card and ATM transactions. So you could, if you opted in, the bank automatically will pay these and you get hit up with the big fee. Some big banks do not do this. So, obviously we're looking at a very specific set of policies and programs at a particular set of institutions. Our data were all collected under their confidential supervisory information. All personally identifiable information was removed. And basically, the goal of this is really to provide evidence about what does it cost to have a checking account, so checking account fees. We conduct multivariate analysis to look at the, account-related factors that are associated with fees. And we also look at involuntary account closure. One of our interests in this was to always also try to understand the demographics. So who incurs these costs? And all we can do here is look at demographics measured for the census tract where the primary account holder resides. As I noted, this is not going to be representative of all institutions because we're looking at institutions that had very specific checking account programs. Regarding our key findings, we find that, not surprisingly, the interrelationships are very complex. They're inherently simultaneous. A checking account is something you put money in, you deposit money because you want to make a payment. So everything is very interrelated, and so this is very reduced form. But we do find, that controlling for certain things really affects, the observed relationships between other variables, and hence univariate relationships can be misleading. Nonetheless, we view this as very descriptive, reduced form, so we're not trying to say anything causes anything. Basically, we find that opted-in accounts incur really, really, really high fees. If there's some question, a policy question is, do people really, are they choosing this? Do they know they're going to be charging these fees, or do they not understand what it means to opt in? And that's a big policy question that people in this area are dealing with. But among these opted-in accounts, we saw that when you do opt in, if you also seek formal overdraft protection, which is basically having your accounts linked to either a credit line or another deposit account, you'll you'll have lower fees. So there are ways to mitigate these fees. And this reflects the fact that these sweep fees, the banks charge you sweep fees, but they are lower than the per item overdraft fees. Not surprisingly, fees and low balances are primary factors associated with involuntary account closure. But for other accounts, and specifically for accounts that aren't opted in, you also see that the balances you have in your other accounts with the bank matter a lot. So it's, banks are looking at a broad relationship. The banking relationships matter. Young accounts have a really, like the survival of these things, they have a very high risk of closure. So if you're less than a year old and you even haven't had time to really start accumulating fees, we find that controlling for everything, balances, fees, there's just a huge fraction of these accounts close. It is sort of interesting. Why are these relationships not sustainable? After controlling for all these bank-related factors, we still do find some interesting relationships between tracked demographics and account fees and closure. And specifically, we sort of tend to see that the types of characteristics that are associated with bad account outcomes tend to be also the characteristics that researchers have found associated with not owning a bank account or using high-cost non-bank credit services. In fact, our motivation for this paper was really that we are interested in concerns about a lack of access to the banking system and the use of high cost, what they call alternative financial services, such as payday loans. When I worked at the FDIC with Ryan and my other co-author, Kim, we had the opportunity to work on a lot of interesting projects about underserved households. And the FDIC produces a biannual survey where they produce statistics about the use of AFS services and bank account ownership. There's other data sources, and in general, the evidence about what types of households tend to be unbanked or underbanked is pretty consistent. Whatever data source you look at, they're going to be people with lower income, no college education, minority status. There's sort of this not surprising set of characteristics that tend to be borne out in the empirical research. And so, everybody, the concern is that maybe we should do things so people have bank accounts. But the other side is that a bank account can really be expensive if you don't have the resources to use it efficiently. And, there's a relatively little data, but, the data when you're looking at checking account fees, specifically overdraft fees, shows that a small share of account holders bear really, really high fees. And so there is this question for these people, is this really a good outcome? And then the other question is sort of, who are these people? And there's really limited evidence about the demographic characteristics of the account holders that are incurring bad outcomes. So our data are confidential supervisory data that we got through the exam process. As I said, they all operated this standard overdraft program. So the way we kind of constructed the data set was we wanted to look at closures, and we looked at a 90-day event window. And then our sample was selected based on everyone who was alive at the beginning of the closure window. And you either have to have closed during the window or remained open. So we did not include voluntary closures. We did do some separate analysis of them for internal policy purposes. And basically, we ended up with more than 500,000 accounts. We then measured monthly account fees. So we took this transaction data. Some of the banks would have like hundreds of fee categories, and you had a code, like what kind of fee is this? And we basically classified two types of fees. What we considered as NSF-related fees is not only including the standard overdraft and the NSF fees, the bank charges, but unlike a lot of other research, we even included things like sweep fees. So Pew's done studies, and they basically find that the typical overdraft fee is $35 for an overdraft. But even if I'm asking a bank to sweep my funds from my deposit account to my checking account to cover an overdraft, they'll still charge me $10. And that's not a zero fee. I have a $20 a year fee for my dedicated overdraft line of credit. That's a fee. So if you just ignore all these fees, it's not like I pay overdraft or no fees. So we view our measure as a little more comprehensive. Everything else, excuse me, is considered a non-NSF related fee. So it's a bank ATM fee, maintenance fee. Thanks. Basically, our data includes a lot of very unique bank account characteristics. One of the most interesting things is that we see the balances someone has in their other accounts. And that can really matter a lot. In terms of our demographics, we basically just use census tract data to measure these characteristics I mentioned as being associated with being unbanked or underbanked. The big takeaways are that, as I said, opted-in account holders incur much higher fees than non-opted-in accounts. In terms of the full sample, account costs really aren't all that high, $9, but opted-in accounts were paying average monthly fees of $21 versus $6 for non-opted-in accounts. Most of these are reflecting NSF-related fees, so overdraft fees do account for most. On the call report, there's a deposit account fee item, and eventually they're going to break out NSF fees. But NSF fees, we estimated in an FDIC study, were 75% of the account fees. So most of the fees banks are raising on their accounts are overdraft fees. The important thing that this chart is saying is that the differences between being opted in swamp the differences that you see across track income groups. So if you just get all these people to stop, not opt in, you'd be making them a lot better off in terms of their fees. The non-NSF related fees, so this is ATM maintenance fees, much less variation, and even though more people have them, they tend to be really low when you're measuring them on an average monthly basis. We see more of an inverse relationship, more of a relationship to track income when we look at the involuntary closures. So this is over a 90-day window. So this is a pretty high, 5% of low income opted in households accounts were involuntary closed in 90 days. So if you annualize that, that gets to be a pretty high rate. Again, opted in accounts had a higher incidence of involuntary account closure. In terms of the account factors, you basically see that obviously you see inverse relationships between track income and things like deposits, balances, households in lower income households, linked accounts, linked savings account tends to be the one type of overdraft protections a bank will offer you. You're not as likely to be offered a line of credit because in many ways these households will often be less credit worthy. In terms of our multivariate analysis, it's not really surprising. You find, if you have a lot of debit card activity, a lot of debit transactions, that's positively associated with your NSF fees. NSF fee is based on a transaction. You have a transaction and you don't have enough funds. So if I have a checking account and I don't use it, I can't really have NSF fees because I'm not engaging in a lot of transactions. We find interesting differences between patterns evident for opted in and non-opted in, and non-opted in accounts, though, and those mainly are in terms of the effects of your your formal overdraft coverage on the likelihood that you incur higher NSF fees. Specifically, as I mentioned at the beginning, for accounts that are opted in, you find having linked deposit or a linked credit account is associated with having lower fees. And that's because if I use my debit card and I have a linked account, I get charged $10. If I don't have a linked account and it's an overdraft item, I get charged $35. We don't find this relationship for non-opted in accounts, because if I'm a non-opted in and I swipe my debit card and I don't have enough money, they'll charge me the $10 sweep fee. But if I'm not opting in and I swipe my debit card and I don't have enough money and I don't have a linked account, they deny the transaction and I have no fee. And then I have to decide, am I going to take it out and use another means of payment, or, I don't make the transaction. The point is that when you're not opted in, you don't get charged a fee when they deny your debit card transaction. It's not clear how much people really understand this. In terms of involuntary account closure, no surprise, fees, low balances are the main things that, drive involuntary account closure. But controlling for everything, was striking to us how high the incidence of closure was for young accounts. That's controlling for their fees and everything else. Thank you. So the closing thing is, in terms of why we started this, the track demographics, is that controlling for this huge array of account factors. What was interesting to us is that we still found differences, specifically bad outcomes that could be associated with certain track demographics, and that is sort of minority. We also looked at households, single households with children. College education, lack of college education. And a lot of the patterns we're finding here are similar and sort of mirror similar patterns that you see for households that don't have bank accounts or who use high-cost non-bank credit services. So in a sense, we're sort of saying this makes sense. We're sort of seeing a mirror image that the people who are outside the banking system may be outside the banking system because they incurred very high fees or closure when they were in it. I don't really have time to go through.
Thank you, Kathy. Very good. Thank you. Discussant is Ryan Goodstein.
All right. What do I do? Is there a keyboard somewhere? Or just... All right, success. Okay. Thanks to the organizers for inviting me to present, and thanks to Catherine for writing this paper. I really enjoyed reading it. So I'm going to try and fly through these comments. I'm pretty sure I'm going to run out of time. So let me just quickly hit the context. I think Catherine did a nice job of motivating the paper. I'll just say that, I'm in my world at the FDIC and consumer research, we think a lot about economic inclusion. Basically, in the premise, of this, specifically about bank account ownership is, the idea is that, bank account access is good for people, that gives them access to mainstream credit markets and all that, sort of a full suite of services that if you don't have a bank account, you're basically shut out from. But of course, this really only makes sense if fees are transparent and affordable. And Catherine talked a lot about that. We just know also, sort of in the last few decades from looking at data from FDIC summary deposits, that fee revenues increased sharply over the last few decades. And overdraft programs in particular have been under a lot of scrutiny. There's been some regulation. Catherine talked about a bit. My understanding, just from reading the paper, is that from reading the newspaper, is that the CFPB has collected this data with an idea of thinking about doing some activity in this area. So I didn't give the disclaimer, so let me just pause and say these are my opinions and not anybody else's. Okay, so as Catherine described, this is she really has access to great data. So not only account level info, but full transaction level info. So not just on NSF fees, but really every transaction that occurs on the checking account. So things like balance information and so on. So this is really great. So the authors, Catherine and Tim, focus on checking account fees, basically what determines checking account fees and what determines these involuntary account closures. So let me just start with the checking account fee analysis. The descriptive tables, they're really well done. I know Catherine pretty well from working with her, and so it wasn't surprising to me how carefully done these are, how thorough they are. They're really a great resource. A lot of it can probably get moved to an appendix at some point, but and so I'll just sort of echo briefly what she said. What she described is that a lot of the variation in the fees, or there is a lot of variation in fees incurred by checking account holders. In terms of the overdraft or NSF related fees, unsurprisingly, the data show that it's consistent with prior evidence, actually from the FDIC and other sources, that there's really most account holders don't have any NSF fees, but there's a small minority of account holders who really bear the brunt of a lot of these fees. Okay, and then the detail on the distribution of non-NSF fees was novel, at least to me, and you went through that, so I won't really cover that here. I'll just reemphasize again that really the key driver of the variation in fees, and particularly the high fees, has to do with NSF-related charges. So in the multivariate models, as Catherine described, what really they're sort of going after a descriptive look at what's going on, and I think they do a nice job of that. One thing I would suggest adding are measures of volatility. So I think with the account level data, the transaction level data, you can do that. And it'll be interesting to see how much, like for example, you said you picked up a lot of, or you picked up a lot of effects for things like race and education, and that might, what's really driving that? It might be volatility in their economic circumstances and so on. So it'll be interesting to see adding that in the model, how much, we can see with that. In terms of, I don't want to dwell on this, the technical issue of the dependent variable being high. So basically the model on the right, on the dependent variable is fees, and as we know, they're highly skewed. And so an OLS estimation, is really sensitive to outliers. And so the way you guys deal with it is you basically transform it into categorical groups and run an ordered logit. And that's problematic for a number of reasons, which you've heard about when it was discussed last time. So I'll sort of skip over that. We can talk about it again afterwards. But there are some alternatives which I think will work well. One is an inverse hyperbolic sine transformation, which is really, my understanding is it's analogous to a log transformation, except it works with zero values. So I can talk to you about some references or examples of how that would work. So with all that said, to be fair, you also estimate a simple logit model, and I think this makes sense. I would suggest looking at high fees as opposed to just any fees. I think that's really where sort of the interest is in terms of policy. I'll come back to that shortly. The results are generally sensible. So as Catherine described, average fee amounts are just decreasing in things like average daily balance, increasing in number of transactions, and so that all makes sense. So when I was thinking about the paper, I was thinking about sort of where to go next. In terms of actionable policy implications, not sure what how much you can do with that. It's obvious. It's clear that the economic circumstances of the account holder matter a lot, but there's not policymakers, at least financial regulators, don't have a lot of sort of control over that. So one suggestion I would make is to focus on fee structures. So I should say I know that these are confidential data, and you probably have a lot of limits on what you can do and publish and so on. But so that stuff aside, it would be really nice to ask questions like, what are the specific parameters of the fee structures that are driving the high fees? Is it, just the level of fees? Is it, other stuff like, do they charge a negative daily balance? Do they charge it repeatedly for every incidence, transaction ordering? So I think these are the kind of things, I think these are all sort of codable in a parsimonious way with the data that you have. And then, estimates on these things would give sort of more direct information and implications for policymakers. All right, so the second suggestion, as I said earlier, is to focus on high fees. I'm not sure how I'm doing on time. Maybe 1 minute. Okay, so let me just say, I think it's probably self-evident. That's, you know, this is really the low-hanging fruit in terms of, like, you know, at a first pass, policymakers probably don't care about the people who have one NSF in a year, but the small set of people who have a ton of overdrafts. What's going on with these people? You know, so as I said earlier, I touched on a little bit, you know, with the transaction level data, you can try and get, you know, there'll be noisy measures, but you can get measures of economic volatility, liquidity. You know, you don't observe everything, but just anything you can say about, you know, what's going on with these people, even on a descriptive basis, would be really informative and really helpful. Okay. In terms of the model of involuntary account closures, I'll just briefly talk about a couple of technical issues with this analysis. One is left censoring. I'm not going to go through the picture. I spent a lot of time in Excel making the picture, but I'll skip it. So I think there's an issue of left censoring where, you know, not that much time. It's not that good a picture, but anyway, you know, so because you just sort of pick up at a certain point in time, there's probably a lot of, or I shouldn't say, it's possible that there are accounts that never make it to the beginning of the window that you're looking at, and so I think a simple solution would be to use a hazard model, you know, and basically just drop accounts that are old. And so the interpretation changes slightly. You know, you don't want to be looking at, you know, sort of new accounts, but probably a lot of the action is there anyway, as you're finding. So, okay, the last thing is the use of NSF fees as a right-hand side variable. So, you know, it's really mechanical. The NSF fees, it's a function of the transactions and the fee structure. And you've got a bunch of controls of transaction activity already in the model. So what's driving the variation, you know, in the NSF fees? It's things like fee structure and the interaction of all this stuff. So I would suggest just taking out the actual fee amounts and putting in the, you know, these measures of the fee structure. Again, that's where the policy interest really lies. And then you can, of course, you can estimate it for different populations of interest to get a sense of, you know, which populations this really matters for. These different things matter.
I hate to say it, everybody. We're gonna have to give them the gong.
Okay, all right. I'll stop there.
That's all right. That's right.
The opt-in, you know, there's a lot more. I mean, it's a separate paper, but there's a lot of work that can be done on the opt-in decision as well. Okay. But again, I will close by saying I really enjoyed the paper, and the descriptive work is really fantastic. It's a great resource to understand what's going on with these fees. So, thank you.
Thank you, Ryan. Questions from the audience?
So it's a really great paper on the policy. Now I have a mic. On the policy implications, it seems to me your data suggests the ability to distinguish between how people are using the checking account with some sort of overdraft use. And it seems to me there's several possibilities. They're using it for liquidity as a payment system. They're using it as a source of financing, or they're using it as a savings vehicle. And when you're trying to figure out what do you want to do, it would be really helpful if you could look at some of the data you have and see if you can distinguish between those types of use. For example, if people are paying these kind of fees, but their alternative source of financing is actually a lot higher, and there Ryan's right. You've got to look at the negative balance fee, and you know, if there's an interest rate and so forth. You know, that's really different, and shutting this down might drive them to a non-bank source that would be a lot worse. If it's a mistake or inattention, and they're really, you know, this is just a liquidity, and they could be using a credit card and not having this kind of cost, then the policy implication is quite different.
I agree. So first of all, I want to respond a little bit to Ryan's. We have a very small number of banks. So it's, you know, we don't have enough variation in terms of the policy structures to really be able to identify, you know, how outcomes for people are related to whether I have a de minimis threshold or something for my overdraft policy. So, you know, that's why we really can't exploit that too much. You know, the two things that, you know, are sort of obvious next steps that I totally agree with. The number one, looking at the volatility question. And I totally agree with you. We need to focus, this was very high level, just sort of to get the lay of the land. I didn't know how much people paid for using checking accounts, and I didn't know, like the distribution of specific types of fees. So this was very much descriptive. But I totally agree, what's really of concern are the people who are paying the really high fees. I don't care if someone pays $50 a year, but, in terms of the alternative credit, what is concerning, because I do a lot of research on payday lending too, is that in fact the people who tend to use payday loans end up having more overdrafts because they can't pay out the payday loan, and then the payday lender bounces their bank account. So although the industry uses the cost of overdrafts as a rationale for using payday loans, people frequently end up incurring more overdrafts when they use payday loans. So, we found the same thing. We looked at deposit advance products and wrote a white paper. And you sort of would think, well, people using sort of a bank alternative to overdraft should have less overdraft. But in fact, we found that the use of these two products is correlated. So.
Question?
Joe Hughes, Rutgers. I would find it interesting to know something about the cost structure of these accounts and how they're being priced, or how the pricing relates to the cost structure.
You mean the cost of having checking of?
The cost of producing the accounts.
Right. So we wouldn't have any data on how the bank evaluates the costs. But it would be interesting.
Please. Yes, please.
Did you hear me, or shall I say
Yes.
it again? Gillian Garcia, formerly with the IMF. In response to your policy question, how can we direct them to credit unions? The fees are very low. Now, if they're employed, presumably their employer has a credit union, so the issue would come up, what do you do for the unemployed? And I don't know if you had an employment variable in your analysis.
No, because we can observe their deposits, but we don't know the source of their deposits. In terms of credit unions, the CFPB does supervise large credit unions. So, we have access to data from large credit unions. Some credit unions do not operate standard overdraft programs, but a lot of them do. A lot of them, and I think one of the big policy concerns for a risk-oriented conference is banks make a lot of money from their overdraft programs. And 10 years ago, when the FDIC started doing its own overdraft research, one of the concerns is that the little banks, if you take away, this trough, actually could have safety and soundness problems. So there's this is a situation where the consumer's bearing the risk and the banks make money off of it. So it is a challenging policy issue. And I don't work at these places, so I can say anything I want.
Anyone else? Thank you, Catherine. The next paper is really part 2 of this dialogue here about really the marginal participant in the financial system. And so the title is, Do State Regulations Affect Payday Lenders? And the authors are James Barth, Jitka Hilliard, and John Jahera, and the presenter will be John.
Yeah. Oh, there you go. Where is that? Or just click it here. There we go. There. Okay.
Well, first of all, we're happy to be here. My co-authors and I are academics, so we talk about things whereas regulators do things. So hopefully we can provide a little information that might add to your decisions as you go out and actually do things. I our paper is about, do state regulations affect payday lending? And I'll go ahead and jump to the end and then fill in the gaps and come back. And the answer is, of course. So some people say, well, you might be proving the obvious. But let me tell you why we got interested in this. First of all, it's a big issue in our state that included a state Supreme Court ruling this Monday of this week. Alabama had a rule on the books that no one could have more than $500 in loans outstanding, so you couldn't go here and across the street. No way to enforce it. The Department of Banking had tried to mandate reporting by payday lenders. Payday lenders sued and has been held up. The Supreme Court upheld the authority of our Department of Banking to establish this database, and I believe they're going to contract with Veritech to take that over starting June 1st. So it was basically unenforceable in the past. We have a lot of payday lenders in our state. You may recall in March, President Obama spoke in Birmingham and made that the focus of his speech, where he noted that we have more payday lenders than we have McDonald's in the state of Alabama. So I will say we don't have as many as Texas, though. So any of you from the great state of Texas. So as we started researching this well over a year ago, we looked at a number of studies, and I don't want to dwell too much on things, but let's see if I can go forward. We started gathering data, and what we discovered is there's a shortage of data since there is no national database that's readily accessible. Most of the prior studies looked at one or two states, relied on survey data, things of that nature, and we've got a whole giant stack of literature. Some looked at one state, Illinois, Louisiana, North Carolina, places like that. So what we did over a year ago, we started contacting each and every state in the country, the appropriate regulators, and asking for the names and addresses of every licensed payday lender that they had. Some states required us to file freedom of information requests, which we did. One of our great 50 states charged us, only one state. Anybody from the great state of Tennessee, they actually charged us. Any Tennessee people here. So it was not a great deal of money, but nonetheless, they made us jump through some hoops before they would even send it. Nonetheless, we gradually accumulated all of this, and even some of the studies that have tried to look at it on a national basis have used the North American Industrial Classification Codes. But if you dig into those codes, they include a few other things other than payday lenders. I can't see Catherine. She's you're aware of that, right? It's kind of blocking you, so it's interesting your talk. In Alabama, one store can have at least 3 separate licenses: payday lending, check cashing, pawn shops. You can have one storefront that does everything, and most states require a separate license. So we decided we want to pull out just the payday lenders, because while these businesses are related, there are differences. When we did that, we've got a table I'll get to in a minute. I'll show you the differences in the data if you use the industrial classification data versus just payday lenders. That's a pretty substantial difference in how many firms. What we found, I'm going to just briefly talk about the data. We found 10 states in the District of Columbia absolutely prohibit payday lending. The state adjacent to ours, the state of Georgia, prohibits it. There are no payday lender stores. They do have small loan companies that charge some fees that can be around 200%, but they're not payday lenders, and they allow a greater length of time, so they're not the typical 2-week loan. Georgia currently has litigation pending, however, against an online payday lender, making the argument that if you do any kind of business in our state, you should be licensed, even if you do not have a physical presence. So we had conversations with their state attorney general's office. Alabama has the same type of thing, according to our bank superintendent. So that's a touchy one with the online lenders out there. But this just is a graphical depiction of states that explicitly prohibit payday lenders. The maximum allowable rates, and this summarizes some of the data. We've got a big table in the back of the paper. And the highest stated maximum rate in the country is the great state of Missouri, if we have any Missouri folks, 1,950%. Now, when I say the maximum, there are several states that have no upper bound defined by law. No upper bound at all, so it's whatever. But Missouri defines 1,950%. In my state, it's 456%. So you can look in the one of the tables in the back and see the whole range of rates and terms and things of that nature. But as you can see, I don't think payday lending is something that most of us in this room would care to engage in for our personal financial needs. So, what's the empirical evidence? Well, it's pretty mixed. There's studies, and I don't obviously have time to go in those, but a number of studies have tried to identify where do payday lenders locate. Again, most of these have focused on just a few states, things of that nature, and looked at the standard demographic data. Are there benefits? Now, we tried to roughly categorize these as saying yes or no, but even the yeses, I'm not sure if we call them benefits, but it may be a state that restricts it severely would find more bad checks being written, for example. So if you view a benefit as you have fewer bad checks, then it's a benefit. So for example, Zenman and some of those others look at it like that. So I don't know that we found any study that said this is the best thing in the world for borrowers in this country. I think you agree. But again, there are some other downsides. Morse, actually, if you're familiar with Adair Morse, looked at sort of disaster situations. If you're in California and you have a disaster and need a true emergency loan, she found there were benefits there. But most of us, I don't think, face those kinds of disasters. Is it predatory? Well, that's a term that people are using on there, and there are some folks who say, yes, indeed, it takes advantage of people who either don't have the financial wherewithal to go anywhere else, don't have the financial literacy to do something else, or whatever. I was interested in Catherine's study because we talked to several bankers about this, and several of them said, oh, we do this all the time. Because I said, why don't you make these loans? They said, we do. We just call them overdraft fees. And some bankers told me we have people who routinely overdraft, come in, clear their account, and do it over and over and again. So, I mean, that was just anecdotal. We don't have the data. I don't know if you may have data on that. But some of the bankers said, yes, indeed, we do make those types of loans. Some other highlights from our data, 2,531 counties around the country, because we use county level data. We have, remember, names, addresses, zip codes, all this kind of stuff, county level data. 2,531 counties throughout the U.S. Harris County, Texas, by the way, has more than any other single county in the country. I don't even know where Harris County is. I need to look. Anybody know? Where's that? Houston. Okay, they have more than anybody else. Even in some states where it's legal, there are over 1,000 counties that have zero. And I will note also, and we've got a slide later, there are actually 4 states where it's technically legal, but they impose such restrictions that there are 0 licensed ones. I think one of those puts a maximum rate of interest of 30%, and the other 3, I think it's 36%. So clearly, payday lenders have decided it's not in their financial wherewithal to go into those particular states. But on the books, we got it in writing from them, it's legal. But, you remove some ability to earn, and it goes away. Texas, you can see, 3,800, almost 4,000 lenders. Maine, the fewest, so anybody from the great state of Maine. If we scale by per 10,000 people, the great state of Mississippi is number 1, South Dakota is number 2, and my state, Alabama, is number 3. So relative to population size, so you get a little different number there. Highlights, some states have much lower rates than typical. They're intended to deter. These are the ones that have low rates, so they don't have any licensed payday lenders. So, one way you can either ban it or you can impose such restrictions that no one wants to do it. 6 had no limits. You can see there, it's rather interesting, no limits whatsoever on the books. Some have no limits on the dollar amount. Some, like Alabama, limit it to $500. So there's just a mix around. Some have minimum loan terms. Colorado now has the longest at 6 months. I believe that went into effect in 2010. There's a bill working its way through the legislature in my state right now that would mirror the Colorado bill. Needless to say, the industry is sort of fighting that, as you might suspect, given that we're number 3 in the country in the number of payday lenders. So they have a vested interest. If you read the details on Colorado, when they did that, it caused a reduction of almost 50% in the number of payday lenders in that particular state. But what was sort of interesting, the dollars didn't go down proportionately. It's rather interesting. And the number of borrowers per store in Colorado nearly doubled. So it's like they got rid of overhead. They said, let's close these stores and get rid of the overhead. And so the borrowers just go to other stores, okay? Now, the problems we talked about, the data, it's been very difficult to get good data. We think we've done the best we can. Like I say, even the states that we knew ahead of time, like Georgia, where it's illegal, being close, we knew that. We forced the issue by making them send us at least an email in writing to say, yes, it's illegal. So we have documentation on every state in the country. And the regulatory regime does vary quite widely. We've got legal status, regulations, the number of the locations. We use the standard demographic data at the county level. And it's a little hard to see here, but this just shows the number of stores versus the proxy data. I know you can't see that too well there. We just want to demonstrate one contribution we think we made is by accumulating this database. If you look at the difference between our data and the industrial classification data, you can see it's quite substantial. At the top, those are the most differences and least differences. So you can see the differences between the databases. So if you're doing data on payday lending and relying on the industrial classification codes, you're going to be including some other things. And that's fine as long as you know what you're doing in there. Okay? By state, you can see Texas, the ones we've talked about, are there. I'm going to go through. And this is just a graphical depiction again. Mississippi, South Dakota, Alabama, Tennessee, Texas, and so on. And what's interesting, Missouri's here. Missouri has the highest allowable interest rate of those that define a maximum at 1,950%. But yet they still have a lot of payday lenders. So again, you know, what happens there? Now, what did we do? Well, we tried to put all of this in the hopper and see what we could find. And without getting into the econometrics too much, we did OLS, but then we also did total analysis. I already got the time notice here, so I'm going to move quickly. And you can see the things that are significant. Interestingly, the percent of the population that's African American was positively related in both the OLS and the Tobit analysis. Hispanic was negative and significant. Asian was not significant. Family size, that should be where it says age. That's the number under 15 in the household. That was not significant in either. Education level was not significant. Poverty rate was, unemployment rate was not for the OLS, but it was significant and negative, as you would expect. To get a payday loan, you actually have to get a payday, so you have to be employed. So people first blush think that. But you can see all of the regulatory variables are positive, okay? Positive and significant, in fact. And we had the maximum dollar amount, the APR for a 14-day $100 loan, the maximum number of loans you can have outstanding at one time, and the maximum number of rollovers. Some of the earlier studies have found that the people that get in trouble the most are those who roll them over the most, as you would suspect, okay? Results, just as I said, significant relationship between the number of payday lenders, negative, Hispanic, Asian, older, education level. In general, payday lenders, not surprisingly, are located in counties in states with more lenient regulatory regimes. I think that's not surprising to anyone. You're going to go where you can do business and hopefully earn something. Okay, policy implications. This is a big one for all of you folks out there. What do you do? Obviously, there's a high demand by virtue of the number of institutions around the country. So there's a demand that somebody's got to meet. If we totally ban them, what's going to happen? Well, I guess worst case scenario, you go down to the corner and you borrow money for 2 weeks from someone who would incur dire consequences if you fail to pay back. We actually called some payday lenders and talked to some. The ones we talked to, we said, what do you do if someone doesn't pay? Nothing. We could go to small claims court, but it's not worth our time and effort. We don't do anything. And there was just a study that came out by the Center for Responsible Lending that only looked at North Dakota because they had data, and they found a 46% default rate for those who roll them over. So there's a high default rate. But again, the cost to try to go to small claims court is just not worth the effort. That's what we found. How are we doing?
Doing good.
Doing
Have a
good.
minute.
So in terms of policy needs, and this is what people are looking at, Alabama's looking at the Colorado model of the 6-month, more or less an installment type of loan as opposed to a 2-week, you pay it all off. Some of the other things that seem to work are limiting the number of rollovers. It just seems like the rollovers escalate. You get it for 2 weeks, you can't pay it, you roll it over, and that interest just piles up higher and higher. So, you know, from a policy standpoint, if a payday loan is truly intended to be for short-run emergency needs, then limit rollovers. I don't think people intended payday loans to be continuous loans. That's what seems to get people in trouble. Some of the regional studies that looked at one or more states in isolation have found the more you roll them over, the more likely you are to get in trouble and default. So that's our recommendation for the policymakers in the room. Take a look at limiting rollovers if you think that's the issue. We're not so sure about capping the rate. If you lower it too much, you're going to be like the 4 states that limit it, that don't have any payday lenders. That drives that type of borrowing underground. I think someone on the small business paper mentioned borrowing from family members. That sometimes doesn't work well. My advice is you treat that as a gift if you lend something to a family member. Since I've had that experience, if you treat it as a gift, you don't worry when they don't pay you back, which also happened in my case. But in any event, we need to encourage banks and credit unions to try to figure out a way they can make a little money at this. That would be another thing for you as regulators, and I'm not sure exactly how to tell you to go about that so they can earn an adequate earnings on that. Okay?
Thank you, John.
Thank you.
Discussant is Christopher Henderson.
Try and find this. See? There you go. All right, thank you. First of all, I'd like to, I'm sorry. Oh, this is not the right one. Let's see. That's what you get for sending revisions. Okay, all right, I think we got it now. Thanks, Jalapa, Ken, and Paul for putting together such an interesting conference and agenda. The usual disclaimer applies. I'm thankful to have the opportunity to discuss such an interesting paper. If you read the financial press, I think many of you will conclude that the payday lending business model is much aligned and there's a lot to dislike about it. But the reality is that there's significant demand for the product by liquidity and credit-constrained borrowers. So you have 2 issues here. You're dealing more with the supply, but there's a big demand issue out there that folks would like to know more about. So integrating those 2 concepts would be extremely useful and helpful. So first, what I want to do is just talk about the goals of the paper to make sure that I understood it for one thing, and to briefly discuss the conclusions. The paper makes the connection between the concentration of payday lenders in the regulatory environment that these lenders operate under. So the author comes to the conclusion that the more lenient the state, the more firms you'll find. He also brings in some demographic variables to conclude that higher proportions of Black, not Hispanic, that's an error, higher proportions of Black residents are likely to be borrowers in this. So the question becomes, what does the paper do well? Well, the paper fills a gap. Okay, the paper definitely talks about the regulations for this particular industry. So tighter regulations could lead to less predatory practices. At least that's one observation that the authors could conclude. So local governments and states might have some control over the laws. They can do something about the predatory nature of the business, either changing some of the rules, changing the interest rate, or changing the requirements on rollover or loan renewals. That's one way to get at reining in this industry. But as a student of this literature, I saw that as being a very narrow focus for the paper. Folks would really want to know, why are these borrowers locked into a cycle of poverty from using this particular product? And why are these issuers so profitable, okay, if there's a lot of them in a particular area? So that starts where my clarifications or my questions should begin. So it is evident that the paper is evolving. The main results of the paper are very clear. You set an expectation right up front, but you would want to know a little bit more about the distribution of payday lenders and the concentrations. So if you have county level data, how is the data distributed across particular states? More importantly, is this a rural or urban type question? Are there more payday lenders in urban dynamics? Are they closer to the central business district? So if you got to that information, which you could by deploying some of the Census Bureau information you have, you could frame a story around search costs. You know, are there lower search costs in credit acquisition, and whether or not those search costs matter? Also, since you're focusing on the supply side of this issue, do the regulatory regimes have more profitability based on where they're located? So can you get to the profitability story around why these firms exist? Unfortunately, there is no true data section in the paper. I don't know if that was strategic, so you keep people from asking for data. But this is a very interesting data set that you put together. So are you missing some interaction terms, especially around the southern states? You could divide your data sample by southern states and other to see if it's just a southern issue where you have this concentration in payday lenders, as well as what we know to be true of high poverty areas in the South. I know the paper is still developing, but you might want to focus a little bit of the analysis to better explain the TOBIT specification. So there's obviously a truncation issue, so you just need to give the reader a little bit more understanding of why that is such a problem, or why is it serious. You also mentioned complements versus substitutes. That argument needs to be brought out a little bit more fully. You also have a future research plan. So if you can incorporate that into your conclusions and talk about the lack of data, I think that would help the reader a little bit too. So I would say the major suggestions I have for this is, are you missing important interaction variables? So I know here in the Federal Reserve System, a lot of researchers tend to merge data sets. I don't know how much access you have to different data sets, but I'm imagining that you could look at some of this county level data or roll it up to the MSA level and look for income or wealth proxies. And that way you can see whether or not some of the shocks that these borrowers are facing will play out in your data. So I'm thinking house price changes, level of consumer debt outstanding, that can help explain some of the shocks to wealth. Merging data sets is very difficult, but you could get to a broader, more robust economic answer or story. So I looked at the data from the CFPB and I thought it told a very interesting story. In less than a year, 64% of the payday lenders renew their loans. Of course, this is a last resort type of product, so borrowers are facing many liquidity shocks over a short period of time. So I asked myself the question, is it really the concentration at the county level of payday lenders that has more to do with the problem, or is it more or less the economic conditions facing the borrowers? Because they're subject to all these liquidity and credit shocks. So if you try to employ more controls, look for more controls. Now, one source could be merging more data sets that might have race, income proxies. I know HMDA does. It could also have some story about county level house prices. Those are some of the things that you could use to come up with some income or wealth shocks and merge with your unique data set to come up with some robust conclusions. But great paper. And I'll just conclude by saying that the paper's still evolving. Can you merge more data? Can you do more than just fill the gap with the application of more robust economic reasoning to have a fuller story? Because some of us would really like to know, is this product locking folks into poverty over long periods of time? And how profitable are these institutions? Because they keep popping up. Thank you.
Thank you, Chris. Questions from the audience?
You're interested in regulatory effects. So the U.S. Department of Justice has a program called Operation Choke Point. Oh, so you're familiar with it. In which they're actually trying to choke off these payday lenders' access to credit. I don't know the time period of your sample, but I wonder whether or not that has an impact.
Well, the data we gathered, again, took over a year. So, I mean, the number of lenders and all has been sometime in the last about 14 months. We put the data as they replied, and as I said, we had to file freedom of information requests. We had to pay Tennessee and all of that. So, by and large, the data is as of the last 14 months in terms of those and appropriately. But that is a good point there. I know people would like to just shut the industry down, but where's the alternative? You got to propose an alternative, is my view.
Another question?
You mentioned at some point that if the borrower does not pay their loan, the bank or they pay their loan cannot go after them. How do they enforce the contract? Can you explain a little bit? Do they report that to the credit bureau or?
Do they report to the credit bureau?
Yes. What is it?
I think from what like I said, we actually called some. We got curious. We even went in some payday lenders and pretended to be potential borrowers. I'm not sure if they do that sometime.
With the tie or without?
Without the tie. I didn't shave for about 3 days, and I shouldn't have said that, but anyway. But it's interesting. I got the impression if you have a job, they'll give you a payday loan because you do have to have a job. It's a payday loan until your next payday, 2 weeks. So if you go in and say I'm totally unemployed, you're not going to get the loan. But no, they don't. Again, it's the time. In our state, the average loan is $325. How much credit investigation are you going to do for a $325 loan? And if it is just for the 2 weeks, you're only going to make this $325 loan. You may make $75, so you're just not going to do the credit investigation for that type of a loan. So,
Catherine?
So anyways, I thought your thing was really cool. The payday loan industry, this Stevens Inc., they advise the Wall Street firms. They produced in the past estimates by state of stores. So it'd be sort of interesting I can send you some of their stuff.
Great.
And then we also did a paper where we used the FDIC survey of unbanked, underbanked household data on households that use payday loans to sort of look at the demographics.
Okay.
But we also looked at the effects of state regulations. We couldn't look at how state regulations were related to the frequency of use, but just the share of the population that used them. And we basically found there wasn't, within a reasonable range of fee ceilings, there wasn't that much variation in how many people used them. It was, what you're saying is exactly right. Once you start restricting it to 36% APR, they can't operate. But my takeaway was, why would a state ever, what would justify charging $25 per 100 if the stores would still operate at $10 per 100, which is what they do in Florida. So, I mean, the slam dunk policy conclusion is the state should just lower the fee ceilings to what is feasible. You know,
Well,
you know, so my home state of Wisconsin doesn't set any fee ceiling, you know, so of course people get charged more there. And the CFPB cannot regulate prices. So I keep arguing to the state people. The state legislatures are the ones that can set a fee ceiling of $10 per 100 that still allows the stores to operate and clearly makes people better off than $25.
That's what Colorado did. I can't remember their fee restriction. I think their interest rate in Colorado can still be 115%.
Yes, but that's different than 500%.
That's different than 500%. That's right.
Right.
That's right. It's a tough industry if you're on the borrowing side, without a doubt. Without a doubt.
Well, I have one view. To answer the question that was raised by Onesime, I think the real thing is the rollovers are the key, because the rollovers create reputation for the borrower. And it's going to be a heck of a lot easier for any payday lender to provide another loan once he or she knows that this borrower continues to come back week, 2 weeks, every 2 weeks, after every 2 weeks. The problem, I don't have data, you know, I don't know the data on it, but I would suspect that the risk is the first guy that comes in the first time, because then the payday lender has absolutely no clue as to whether or not this is a viable, and I want to put this in phrase, long-term borrower. This, I believe, may be the only way for these people to, you know, get liquidity. That may be, you know, the optimal competitive structure. I just have no idea, but
But the point is that if that's the only place they get to go, the payday lender has them over a barrel, and the
Not if
payday
it's
lender.
competitive.
No, I mean, in this other paper I did, we argued that the competition is exactly that. The states charge the fee ceiling, you know, the lenders charge the fee ceiling, but then they compete by where they put their stores.
Well, basic economic theory would say competition brings prices down, but that does not appear to be the case with regard to payday lenders. So it defies everything that we all learned in school at one point in time, right?
I would want to add that maybe, maybe not. I mean, we don't know what the real risk return for these payday lenders is. We just don't know.
Well, the North Dakota study, you're talking about the rollovers of long-term lenders. Did you see that just came out in March? And in fact, I can't remember. I think after the default rate goes up with each rollover up to, and it gets to like 46% after 6 or 8 rollovers. So the first week, there are people who get a loan for 2 weeks, come and pay it off as they should. People who have a true emergency, short-term duration. But it is the rollovers. And that default rate goes up and up with each week.
I have a question, Rajesh Govindan, JP Morgan Chase. For how large a loan does the payday lender make relative to the person's paycheck? So if a guy is expecting a check of $500 in 2 weeks' time, how large a loan is
Some of them can be pretty large, varies from state to state. I think in Colorado, though, isn't it down to 4% now? Colorado, I think
they restrict the payment.
The payment, yeah.
So in Colorado, the structure has evolved to an installment loan, basically.
Yes, installments for no less than 6 months. But yes, sometimes relative to the income, it can be very high.
Yeah, because, you know, I mean, because you'd think that the payday lender also, you know, wants to cut his own risk, right? He's not going to make the loan so big that he knows the borrower is not going to pay back, right?
Anybody else? Well, then I'm going to turn it over to Jalapa, who will tell us what to do next.
Okay.
Thanks for everyone.
We have a break now. Please come back at 4:15. That we have some food and drink just outside the room.